Right, good morning, everyone, and welcome to this morning's webinar sponsored by Pacific Life, Risk Reduction for Non-Qualified Defined Benefit SERPs. I am Jordan Foster, Director of Communications here at AALU, and I am pleased to welcome our presenters, Marty Menon and Russ Proctor, to speak with us this morning. Marty joined Pacific Life in 2012. He's a director in the Retirement Solutions Division, and his specialty is consulting with companies to customize solutions that solve financial risk inherent in their pension plans through the Pacific Life suite of pension risk products. Marty also works with companies who've defined contribution plans such as 401k or 403b plans to provide guaranteed lifetime income options for plan participants. Russ Proctor joined Pac Life in 2011, and he's also a director in the Retirement Solutions Division. His responsibility is consulting with companies to reduce and remove financial risk inherent in their pension plans through the Pac Life buyout, buy-in, and insured LGI solutions. Russ also works with companies who have defined contribution plans like Marty, such as 401k, 403b, to provide lifetime income options for those participants. So Russ and Marty, I am going to turn the floor over to you. I do want to remind everyone on the line that to please use the Q&A feature to ask any questions during the webinar, and we will be happy to answer those as we go along. Otherwise, gentlemen, the floor is yours.
Great. Thank you very much, Jordan. And we want to thank the AALU for allowing us to do this webinar. We really appreciate it. Thank you very much, Jordan, and Carrie Green and Rachel Lindsay and everybody else over there at the AALU. We really appreciate this opportunity. I am just going to talk briefly about the agenda that we have for today, and then I'm going to turn it back over to Russ so that we can go through our slides here. Jordan, for some reason, I'm not able to switch. Do I need?
There we go. I see it.
Yeah, I see it change, but I think, Jordan, did you change it or did I?
I just jumped in, so if you want to just give me the cues here, if that's taken a little bit, then I'm happy to swap for you.
Thanks. Appreciate it. Hey, Russ is going to do a quick overview of what's going on in the pension risk transfer market and why the topic of non-qualified SERPs is worth looking at. I'm going to jump in and talk about why we're even worried about defined benefit SERP risk. We'll talk a little bit about our solution here, the non-qualified buy-in, which we refer to as Pacific Secured Buy-in, and then we'll summarize it. So, Russ, why don't you take it away?
Sure. Thanks, Marty. Yeah, we're going to start off with the qualified defined benefit area and some of the stuff that's going on there. I think it really sets the groundwork for some of these opportunities in the SERP area. Going to the next slide. What's really happening is an explosion of pension risk transfer in this defined benefit area, and a couple reasons for that. One of those is just the volatility in both the assets and the liabilities of these defined benefit pension plans. The slide here that we're looking at is the S&P 500 since 1995, and it's been very volatile, and as we all know, it's always been volatile. The swings in that market, within a month's time can easily move those assets, 3% or more, and that affects the plan sponsor's balance sheet as those assets are moving around. So that investment risk is inherent in these defined benefit plans. On the next slide, we look at the liability side of the equation. And so with the defined benefit pension plan, the liability is just the discount of all those future benefit payments. So that interest rate that's used to discount it is going to affect that liability. This chart here is just showing the 10-year treasuries for the last 5 years. You can see those have been very volatile, and again, changes here within a month's time. That 10-year treasury is easily been bouncing around 30 bips in a month's time, and that can translate into 5% change in liability. So you're combining that with the assets that are moving around and the liabilities that are moving around. It's causing a lot of volatility for these plan sponsors. Interesting to note, the average 10-year treasury was about 2.13% for the last 5 years. So even though I think a lot of people still think interest rates are low, they are certainly higher than they've been for the last 5 years. I think today's 10-year treasury was about 2.38, so still above that average there. So this shows the interest rate risk side that these plan sponsors are focusing on. If we go to the next slide, this is really combining those things together. If you look on this chart here, this is a chart of the largest 100 pension plans in the United States. So this is put together by Milliman, that they put this out each month. The bars there are really showing the dollar amount of over or underfunding of these pension plans. That's on the left axis. The line that's in there, that's the funded ratio. So that's the assets divided by the liability. So in a perfect world, your plan would remain exactly 100% funded. So if you look on the right axis there, that 100% line, that's really where we'd want to remain. And you look throughout the history, back in 2000, the average plans were well funded over 100%. Then the crash in 2002 dropped them down to under 80% funded. They finally climbed their way back up to be 100% funded, only to have the 2008 crash hit them again. So in a matter of months, these plans go from 100% funded to down below 80% funded. And then since then, they've really struggled with the volatility. The line has gone, up and down, getting close to 90% at one point, getting knocked back down below 80%. And today we're still right around that, 85, 86% funded. So still struggling to get back to 100% funded. And this is really one of the drivers of what's going on in the defined benefit area. And even though this funded status type volatility has been there all along, it's one thing when this is your main plan and this is what you're using to attract and retain your employees, you might be able to tolerate that volatility. But so many of these corporations have frozen their plans. So this is no longer the plan they're using to attract and retain employees. They're fully onto the 401k or defined contribution plan. So this now volatility on this old funded plan that's not benefiting anyone is just a nuisance for them. And so it becomes more and more of a pain, as this volatility, every time that funded status drops, that directly affects their balance sheet as a reduction to shareholder equity. So it's causing a problem and wanting them to get that off their balance sheet. If we go on to the next slide, really, as we start to think about, well, why is it so much now if this has always been around? And one of those is the administrative expenses that are increasing for these plans. Defined benefit plans have to pay a premium each year to the Pension Benefit Guaranty Corporation. That's what the PBGC stands for. There's two parts to that. The first one is this flat rate premium. This is a dollar amount per participant in the plan. You can see that increased dramatically from $35 on its way up to $80. So it's about $69 this year. So that's going to be a 130% increase in this cost. So even if your plan is fully funded, you're still penalized in essence for just the number of participants in there that you have to pay this premium. So more and more companies are trying to reduce the size of their plan. Fewer participants is going to result in a lower premium. So they're taking pieces out of their plan, reducing the size of it, transferring that risk over to insurance companies. The other side of the PBGC premium on the next slide is the variable rate premium. So this is charged based on if the plan is underfunded. So as we looked at that prior slide on the funded status, you can see that most plans are underfunded. So they are paying this variable premium. And this, based on the amount of underfunding in 2017, they have to pay 3.4% of that as a premium or a penalty for being underfunded. So if you look over the last 7 years here, about a 390% increase in that premium. So this is really triggering plans to get rid of these plans completely. They want to fully fund it to avoid this variable rate premium. Often looking at that interest rate, many of them are thinking I can issue bonds or borrow money at less than that 4.4% that they know that variable rate premium is heading towards. So they'll borrow the money, fully fund the plan, or use cash to fully fund it to avoid this premium. And then that brings up, once they've fully funded the plan, there's really no longer a need to keep that frozen plan. They'll just go ahead and start the termination process and transfer that off their balance sheet. And we've seen this in dramatic numbers. If we look at the next slide, just looking at the total sales in the terminal funding or buyout market. So this is transfers from defined benefit pension plans to insurance companies through annuity purchases. And when you look over the history of it, for about the last 20 years, it was under $4 billion a year, averaging about $2 billion a year for about 20 years. So pretty sleepy, steady market until it hit in 2012, actually, the huge transactions for General Motors and Verizon was about 33 billion. But even since then, when we exclude them from these charts, so they don't distort it, but you can see that in 2012 to 2013, significant increase over 4 billion, and then to 9 billion and to 14 billion the last couple of years. So dramatic growth there in transfers. Companies are moving a lot of money out of their plans into insurance companies. So one thought might be, well, have we topped out now at about this 14 billion? But look at the total market. There's about $3 trillion in private sector defined benefit plans. About 40% of those plans are closed or frozen, so they're no longer going to be part of that company's future. So if you're thinking about that, about $1 trillion of assets in these closed plans, about half of that is for retired liability. And the retired liability is the most likely that's going to go to the insurance company through an annuity purchase. So that's $500 billion in retired liability that's going to be transferring to insurance companies over the next 5, 10, 15 years. So if you even figure that over 10 years, that's 50 billion a year that is expected to be transferred. So the 14 billion is really just scratching the surface on what's coming. And I think as we look at this in terms of the SERP market, this is their qualified plan I'm talking about here. But as these qualified plans go away and they completely terminate and are off the books, the companies are no longer going to have any qualified defined benefit plans to worry about. But they may still have the SERP plan, which will also be a defined benefit type of plan. So I'm going to turn over to Marty to kind of go through the SERP side of it and why this is kind of setting the groundwork and affecting what we can do now on the SERP side.
Thanks very much, Russ. So we wanted to provide that background of what's going on in the qualified plan space to give all of you a good idea of, well, why are we worried about defined benefit SERP risk now? Obviously, many of you have been working on SERPs and helping companies finance or fund their SERP with corporate life insurance over the years. But really, the whole point here was to show you that the environment's changed pretty dramatically. As Russ pointed out, that huge increase in premium that we're seeing in the group annuity marketplace surely indicates to all of us that a lot of these companies are focused on de-risking their qualified defined benefit plans. And as many of you know, a lot of them have defined benefit SERPs. So the question is now, well, what's going to happen and why are we worried about defined benefit SERP risk? Well, a lot of the same things are happening in the non-qualified space. And by that I mean that if a company's frozen or closed their qualified defined benefit plan, it's very likely that they've frozen or closed their non-qualified plan. So they're asking, what do I do with my non-qualified defined benefit plan now that I've either started to solve the risk for my qualified plan, actually maybe fully terminated the qualified defined benefit plan, and so these issues are now kind of coming to the surface again and are being asked more often than ever. And in the qualified plan market, they're offering lump sums. As many of you know, you don't necessarily want to offer lump sums to a non-qualified plan participant. As Russ mentioned, a lot of annuity purchases are occurring for retirees primarily. And again, you can't necessarily purchase an annuity for an executive and just hand it to him in order to solve for the money that you owe him through the non-qualified plan. And then there's full plan termination. Not something you can necessarily do here either in the non-qualified space. So our point here is that non-qualified defined benefit SERPs require a different solution. And the problem though remains that, well, if you're trying to de-risk a non-qualified plan, you have to take into consideration the issues of constructive receipt, in addition to other things that you're paying attention to. So, you know, a CFO might have the same goal of de-risking the non-qualified plan, but you've really got to look at the situation differently. For example, you've got longevity risk in the non-qualified defined benefit SERP, because the elections that each of the executives made would typically follow exactly what they elected in the qualified plan. And in fact, the longevity risk might even be bigger in the non-qualified plan because, as we all know, highly paid executives who make a lot of money and their spouses, they're going to live longer than the typical participant in a qualified defined benefit plan. You also have investment risk. As many of you know, a lot of companies may not have even financed these non-qualified SERPs. A lot of them use corporate life insurance, obviously, but many out there are still not properly financing their non-qualified defined benefit plans. So they have the same investment risk, they have the same interest rate risk, because if they go out and buy bonds or buy treasuries or buy equities, all those same risks exist in terms of trying to finance this defined benefit obligation that they owe to their executive participants. There's also liquidity risk, very similar to the problems that they have on the qualified plan side. Again, on the non-qualified side, does the plan sponsor have the funds to pay all of those promises that they have made to all of those executives? And years ago, when these plans were first set up, no one had actually necessarily retired yet. You don't have the big population of executives who were actually in payment status 20 years ago. Now that these plans are closed and frozen, and a lot of these executives are starting to retire, the company now has that liquidity risk. Where do they come up with the funds to pay these benefits? So the reason we wanted to talk to you today about this idea of using a group annuity contract is a plan sponsor cannot de-risk the DB SERP in the same manner, right? Because you pay lump sums, you can't roll over the lump sum of the IRA. If you terminate the plan and you accelerate payments and you face 409A, you might actually have even more tax due because of the excise tax under 409A. And then if you went out and purchased annuities and gave that annuity directly to the retiree, you're going to create constructive receipt for that executive, and you're going to possibly even face a significant tax gross up if you take that route as well. So what's a plan sponsor to do? You know, this isn't, by the way, and many of my former colleagues have approached me and said, well, are you trying to replace corporate-owned life insurance as a solution for funding these SERPs and financing these SERPs? And the answer is no, not at all. This is an alternative. As many of you know, because of the COLI Best Practices Act, if your executives are retired, you can't have corporate life insurance anymore as a good solution. So this is an alternative solution to the common practice of using corporate life insurance. In fact, if you really think about it, this is still corporate-owned insurance that we're talking about, but it's corporate-owned longevity insurance. And I'll talk about that in a minute. So we refer to this solution as the non-qualified buy-in. And it does have a little bit different tax considerations that we want to talk about as well. The non-qualified buy-in is a great way to transfer risk to an insurance company. It's a contract that acts and solves the same risks that it does in the qualified plan space. Point being, the longevity risk, which is a very big risk in these situations, can be solved by using an annuity to finance the SERP obligation. Also, the investment risk. Once an annuity is purchased, it solves the investment risk as well as the interest rate volatility risk and the liquidity risk. Where do I come up with the monthly payments to pay my executives? Especially now that a lot of these plans have matured and that these participants are retired. Keep in mind that these companies now, with getting rid of their qualified plans, are going to have these standalone, non-qualified defined benefit plans to worry about. And the executives who are the last standing participants in these plans are going to be looking over their shoulders and saying, well, who after me is going to be worried about this? I'm the last guy in to these plans. a lot of you are familiar with annuities and maybe the downside of annuities. And by that, I'm referring to Section 72. Because we always would look at Section 72 and say, well, wait a minute. Why would I use an annuity to finance a non-qualified defined benefit SERP? Because the deferred annuity is going to be taxed on basically the inside buildup, or what the IRS calls gain in the contract. But here we're talking about covering the retirees only. And that's one of the key factors here as we consider the use of these group annuity contracts as a solution for financing defined benefit SERPs, non-qualified defined benefit SERPs. And by the way, as the executive participants retire, they can be added to the non-qualified buy-in as they retire. And we'll talk a little bit about that. Again, Section 72, just to give you a little bit more information here, talks about, taxation when the contract's a deferred annuity. But there's an exemption under Section 72. And that exemption says that if it's an immediate annuity, in other words, it's an annuity that immediately starts making payments, that the annuity is exempt from that inside buildup taxation. The other nice feature about using a group annuity contract too is, and I'll talk about this in a minute, the exclusion ratio. Because when you compare a taxable portfolio of investments against the exclusion ratio that can be used and applied in an annuity contract, there's a certain tax efficiency there that can be picked up. And the exclusion ratio is described in IRS publication 939. And let's talk about that for a minute, because a lot of companies are using taxable investments in order to finance their SERP obligations. Imagine, for example, if you had $1 million in a taxable portfolio and it was earning realized gains at 3%. You'd have a first-year taxable gain of $30,000. Pretty straightforward, trying to keep the math simple here. And if this corporation paid a full-on 40% tax rate, they'd owe tax on that gain of about 12 grand. If tax rates were lowered, and there's a lot of talk about corporate tax rates being lowered, that tax due would be about $6,000. Now, in the case where maybe they had a SERP obligation of $65,000 to an executive, they'd take the $30,000 of gain, take $35,000 out of their pool of assets of $1 million, come up with that $65,000 and make the payment to the executive. So keep in mind that $12,000 of tax due. Let's look at an annuity for a minute, earning approximately the same internal rate of return of that 3%. If we paid $1 million of premium, which would produce an annuity payment on a 65-year-old male for a life annuity of about $65,000 a year, using that exclusion ratio, which would be about 76%, that tax due, that gain, would be much smaller. And that's because of this exclusion ratio calculation, which basically says a good 76%, almost 77% of that $65,000, or about 50 grand, would not be taxable. The differential between the $65,000 annuity payment and the $50,000 of basically returned basis premium would result in a difference of about $15,000. Again, at a 40% tax rate now, you're seeing a tax obligation of $6,000 versus on the prior screen, as I said, it was about $12,000. So what we've seen here now is an effective tax reduction of about 50%. And we think that might matter quite a bit to corporations. So we just wanted to show you an example here. This example is just for illustrative purposes, but keep in mind that there is a certain efficiency here in using an immediate annuity to finance a SERP obligation when compared to fully taxable investments.
Hey, and Marty, on that one, just to kind of add in with that tax benefit, it's really the fact that you're able to spread out that taxation. So instead of having the higher tax up front, you're able to defer some of that tax.
Exactly. Yeah, that's exactly right. I mean, we're not saying you get away from the tax. We're not saying that over the life of the investment that you've completely reduced the tax by 50%, but what we are saying is that annually it does spread it out. You know, every company's going to analyze the situation differently. All of you who have done these kinds of cash flow analysis over the years, it's something to keep in mind to help the company understand, why would I use an annuity, and then why would I see a difference in how my tax is paid. And we just wanted to show you an example there. And again, every situation is going to be different, but Russ makes a great point. It's how the gain is spread out over the life of the contract when you're able to apply the exclusion ratio to these annuities. So here at Pacific Life, we actually branded this buy-in annuity solution, and we call it the Pacific Secured Buy-In. And we think it's a very unique approach to financing non-qualified defined benefit SERP obligations. We want to talk a little bit about the process here. Again, because of Section 72, we're talking about covering the retirees, those who are in immediate payment status. That's because of the whole issue about taxation on deferred annuities. Now, what we typically do is we calculate the premium, and we'll provide that quote based on that day's interest, and this is going to change regularly. So, in other words, we price the annuity premium based on current market rates. Once the plan sponsor says, yeah, let's do this, it's a one-time premium payment. We've been asked several times, can the plan sponsor pay this over time? And we could split up the issuing of the annuity contract, but it would be done each year and priced each year, and you might do 20% of the obligation, but let's assume for now that we're covering all the retirees all at once. So the contract's signed by the plan sponsor, they pay that one-time premium to us, and then that contract is put in place. Once the contract is signed, we make payments for all of the covered participants for all those annuity amounts that are covered in the contract. Now, here's the interesting thing is we make a monthly single bulk payment to the company or a rabbi trust if that's what the company wants to use to hold the annuity contract. Keep that in mind. We're making the payment to the company or to the company's grantor rabbi trust. We're not making the payments to the executives. Really important when it comes to talking about constructive receipt. This is simply an asset purchase by the company so that they can cover and finance their SERP obligation. Again, the monthly payment's going to be equal to the aggregate monthly benefit payments that are owed to those executives. By the way, really quick, we have a question about the slides being available, and absolutely, we'll not only have a recording of this, but we'll definitely make the slides available to everybody after this webinar is over. So keep in mind here that from that whole constructive receipt standpoint, the company is still 100% responsible for the benefit payments that are due to the individual participants in the SERP. Really important, again, from the constructive receipt perspective. So from the retiree perspective, from the executive's perspective, there really is no visible change. From their point of view, those payments are still being made by the company. The company is still responsible for tax reporting because, again, annually the company is going to be deducting these benefit payments that are made to the executives. So all tax reporting is the obligation of the company. One of the interesting things that we offer and that we think is very, very important here is the contract value. And what I mean by the contract value is, as I mentioned earlier, the purchase of this group annuity contract to finance the SERP obligation. It's an asset purchase, just like any other asset that the company might hold to finance this non-qualified benefit obligation. Well, if the company wrote us a check for $10 million, most likely they'd want to know on a regular basis, what is that asset worth? And it's very important there for them to understand that we're going to provide a monthly contract value so that they can keep tabs of the value, the asset value of this group annuity contract. So every month, and this is in our contract, and it talk about how it's measured, the monthly valuation is provided to the plan sponsor so that they can book that contract value as an asset of the corporation, or again, if the contract's held by a rabbi trust, as an asset of the rabbi trust. Now, the contract value is based basically on the discounted projected payments that we owe based on the participants who are covered under the contract. We use a very transparent pricing process, and that way the plan sponsor will always know the contract value as it changes based on current market rates. Now, the great thing here is that from a balance sheet standpoint, if you think about a plan that's got all retirees in it, and let's assume the company covered all of those retirees, the contract value should track the SERP liability, because assuming this SERP is now valued on a standalone basis, the SERP is measured as the discounted present value of those future benefit payments. That's the liability. If you have an annuity contract that also is making payments in the same way, 100% JNS or life-only annuities, whatever the payment obligations are, if you think about the annuity contract value, that too is going to be valued based on the projected payments that are owed by the insurance company. Now, someone's asking a question. This is a perfectly timed question. Thank you. What about the contract value upon surrender? This contract is an annuity contract. So when we talk about contract value, it's really an accounting measurement of the contract value. Pardon me. This contract cannot be surrendered. So there is no real surrender value. There are no surrender charges to consider. This is a permanent solution for a permanent obligation, by the way. So there is no issue there in terms of what is the contract value upon surrender. As with all annuity contracts, and this happens in the qualified plan space the same way it does in the non-qualified space, when you purchase an annuity contract to finance these obligations, this contract is not surrenderable. But the contract value is something that the accounting firms, and we've worked with all of them now about how to measure this. Some are a little bit more ahead of the issue than others. The point is that you've got to be able to value this thing, this group annuity contract, so that you could book it on your balance sheet.
Yeah, Marty, if I could add one thing to that too, with when you think about the reason that contract value is well helping on the balance sheet, this SERP liability, each year the plan sponsor is measuring that SERP liability based on the interest rates as of December 31st of that year. So that can be very volatile from year to year. So you might have a $50 million SERP, for example, that because interest rates went down, that SERP liability goes up to $55 million. Well, that increase of $5 million now has to be adjusted on the balance sheet as a reduction to shareholder equity. So that's why the plan sponsors are very concerned about that volatility on the SERP liability. Well, if you have this buy-in contract value that moves with interest rates the same way that your liability does, your $50 million of contract value would then go up to $55 million if interest rates went down. So the net effect is it has no impact on your balance sheet. So that's the value of having this contract value that moves with the liability. And just one other thing we mentioned, we provide that contract value monthly. Some plan sponsors may choose to only actually book that change annually. So it's available monthly if you want to see it. If there's something happening where you have to do some mid-year accounting, you have it available. But you may just choose to book it annually the same way you change your SERP liability.
Yeah, great summary, Russ. Another participant's asking about can we do this for only one SERP participant? The answer generally is yes, we certainly can, but think of it this way. You know, these annuity contracts are priced the same way that you'd price the liability. And by that, I mean that you're looking at mortality and longevity risk. And so when we think about, like, for example, just covering a CEO who's got a large SERP benefit, we've looked at a few of these now, those CEO SERP obligations can be pretty large. When we issue these, we don't do any medical underwriting. They're effectively priced on a guaranteed issue basis. So if we're talking about a very large obligation on a single life, the pricing is going to be very conservative. And I bring that up because really the best way to spread the risk for a plan sponsor would be to cover more lives. In other words, we'd prefer to look at a group of 25 executives. In a lot of ways, think of it the same way that many of you have looked at guaranteed issue coverage in the COLI market. You know, if you said to a company, Pacific Life, for example, and you said, hey, I want to buy $100 million of life insurance on one CEO. Are you guys okay with doing that on a guaranteed issue basis? Obviously, we would say, no, not really. We'll only go up to a certain limit. That same kind of mentality comes into play here in terms of pricing these group annuity contracts. In other words, the more lives we have, the more we can spread our longevity risk, the better pricing we'll be able to offer for these group annuity contracts. So a SERP with more participants to be covered is going to be priced better than a single contract with a single life. Hopefully that's helpful. Actually, this is great. We really appreciate the questions. Another question's coming in about, do we have accounting opinions or references for booking a contract value? And absolutely. In fact, as I mentioned, we talked to all of the accounting firms. One in particular, we've talked to quite a bit at length about this, and that's PricewaterhouseCoopers, pardon me. PricewaterhouseCoopers has actually written 2 papers primarily focused on the qualified accounting for a group annuity contract held inside a trust. But the same authors and a lot of the same experts over there have engaged with us about the accounting treatment for a group annuity contract held inside a rabbi trust or held by the company. There are certain ASC, accounting standards that cover a contract like this, and again, how it would be valued, how the future payment obligations from us, the insurance company, would be discounted to create a contract value, how it would be, sitting on the company's balance sheet, et cetera. So PricewaterhouseCoopers, and we'd be happy to share with those of you who are interested, the papers that they've written. They're publicly available out there that address accounting for buy-in annuity contracts. So PricewaterhouseCoopers would probably be the best company to ask those questions of. Ernst & Young's dabbled in it a little bit. We've talked to Deloitte as well, and KPMG is getting up to speed. So there is some information out there. They've touched on publicly the applicability of these in the non-qualified arena. And again, we've engaged with the folks who have written these papers, and they're, I'm sure, very happy to answer questions for your clients. They're actually working on some of the projects that we're working on. And so there is, and as this becomes more and more common, I'm sure we'll see a lot more information out there about the accounting treatment for these group annuity contracts.
And I'll add to that a little bit. Obviously, this being a fairly new solution, that there is going to be some discussion with the auditor. It's really up to your auditor, obviously, of how they want to account for this. So that there could be different ways of doing it, where they may want to calculate, look at the SERP liability, calculate that completely separately, look at this insurance contract and calculate that, or look at the contract value for that. So they could be different. In the qualified space, we are seeing when they're using the buy-in, they're very often just looking at that contract value for the buy-in and using that same amount for the pension liability for those folks as they do for the assets. So on the qualified side, we see that matching exactly. On the non-qualified side, since there's a little more separation between the liability and the assets, it could be done differently, but certainly a discussion you have to have with your auditors. And as I mentioned, several of the accounting firms are looked at that already, as well as, we've been involved in conversations just to help your auditors understand exactly how this works.
So we just wanted to summarize here before we get to any more questions about the idea of using this specific secured buy-in for non-qualified defined benefit SERPs. One of the main benefits is, again, assuming you have these annuity obligations payable as promised to the company's executives, you've now locked in, on the previous slide, thank you. You've now locked in your future costs. So let's assume you've got 5 executives in the SERP, and you've got these promises and their payments are due. Once you finance that obligation with a single premium group annuity contract, it's a one and done. You've locked in those costs. You don't have to worry about future investment risk. You don't have to worry about the market going up and down. You don't have to worry about changes in interest rates. And by the way, you also don't have to worry about participant mortality. And that's something that's really important here, because in some situations, the obligation is due to the spouse of the executive in addition to the executive. So keep that in mind, because spouses of high net worth executives could easily end up, there's a lot of evidence today from the Society of Actuaries that a married couple, especially a high net worth married couple, could have one of them survive to age 95. And it's about a 50-50, chance of survival. So point being is that there is significant longevity / mortality risk here that these plan sponsors are facing. And they can transfer that risk to us. That's really the point, is these non-qualified defined benefit SERPs present all those risks that we mentioned earlier, the longevity risk and the investment risk and the liquidity risk. So the same risks that these companies are facing in their qualified plans, they're facing in these non-qualified plans. And they could transfer that risk to us with no worry and no intention of having to terminate even their qualified plan. So this isn't just for those companies that have terminated or starting to de-risk their qualified defined benefit plans. This can be done for a SERP today, whatever state the plan sponsor is in right now. And if you think about it from an asset and liability standpoint, again, all the conversation we've had about accounting and contract value treatment, et cetera, that SERP liability is remaining on the plan sponsor's balance sheet. The Pacific Secured Buy-in contract value will track that SERP liability. Again, as Russ mentioned, every accounting firm, every company is going to look at this a little bit differently about, well, if my mortality assumption on the liability side is X, do I use what Pacific Life is using on the contract for the annuity, et cetera? Those conversations will always happen, and we're happy to engage in those conversations. But let's assume, all things being equal, that SERP liability and that contract value will move in tandem. As interest rates go up, each of their values should go down. As interest rates go down, each of their values will go up. Whether the actuary comes in and says, hey, I've got to change the mortality assumption here, that mortality assumption should be in line with what we've assumed in pricing the contract value for the group annuity contract. So again, there's a lot to be said for removing risk, providing a better asset liability match, and locking in future costs here to truly solve the risk for these non-qualified defined benefit SERPs that are out there and in a lot of ways are not being addressed as companies are de-risking their qualified defined benefit plans. So moving on just to the last screen here, and again, we're going to show the slides to everybody who has signed on to this webinar. We really do appreciate everybody sticking around here. We wanted to do just a little bit of a chart to compare what we're doing in the qualified plan space, which is the column on the left. That's our transferred buyout contract. By the way, the secured buy-in can be used for a qualified plan as well. But we wanted to show you kind of the differences between the two in terms of the various ways that we look at these contracts, how we calculate the premiums, who the contract is being held by, cash flow issues, contract values, etc. And just wanted to make sure that you had a kind of a global summary of the differences between what's going on in the qualified plan space and what's commonly known as a buyout versus here what we've talked about for the last hour that we refer to as a buy-in.
Yeah, and Marty, one thing that I wanted to add, though, although it may be a rare situation, you do have the option to convert the buy-in to a buyout. So a situation where, you know, you've only got one executive left in the SERP, and maybe you think he's going to live another 20 years. You don't want to keep paying that for another 20 years. You could just transfer this to a buyout, transfer the annuity to that executive. He would have constructive receipt at that point, but it is a way to just kind of close it off of your balance sheet. So you do have that option to eventually get out of it completely if you wanted to.
Yeah, Russ, you make a great point, because there could be the situation that not where there's just one executive left. What happens for a company that perhaps goes through a change in control, for example? They've done this very thing that we've talked about here. They purchased the group annuity contract. They put it in a rabbi trust. They're ongoing for 5 years. Everything's running smooth. The company gets purchased and goes through a change in control. What do they do then? Well, they may terminate their SERP, right? There may be provisions in the SERP contract, in the SERP itself agreement that says, well, when there's a change in control, hey, the plan gets terminated and everybody gets paid out. As Russ mentioned, the beautiful thing here is that the buy-in can be converted to a buyout, and then we would issue the certificates to the executives and pay those executives directly. So keep that in mind, that there's some flexibility here too that answers the problem of, well, this is great while the SERP is in place. What happens when the SERP does actually get terminated? So we can pay the executives directly, as Russ mentioned, and they'd obviously be in constructive receipt of the present value of that annuity, and that can be addressed in a variety of design ways. For example, you might just purchase the after-tax cash flow necessary to pay the executives. And we could talk about that too at some point in the future with each of you who have questions about that. But point being is that there's a lot of flexibility here. So don't just think that the solution that we're talking about is just set in a certain way and built a certain way, and it has to be, you know, a square peg in a square hole. There's some creativity into how the cash flow can be structured to match the needs of the plan sponsor or to match the needs of the executives, et cetera, et cetera. So we've done some very interesting things in terms of matching cash flow targets and things of that nature to make sure that we're taking these kinds of deductibility points into consideration, et cetera. So we're almost at the end of the hour. There are a couple more questions, some of which I think I'd rather answer offline because they're getting a little complicated. So we'll certainly follow up with everybody who's got some questions here. Again, we really appreciate the AALU helping us host this webinar today. It's been very nice to be able to be with the AALU. We will be at the conference in May. We're sponsoring a booth. We encourage those of you who were listening today to come by the Pacific Life booth. Russ and I will both be there. We're looking forward to engaging with you and talking more about this idea of using a group annuity contract for a non-qualified SERP. We also, I think, are making a presentation on Sunday afternoon at the AALU meeting, so we're hoping a bunch of you can be there too. And Jordan, I think we've reached the end of our presentation.
All right, well, Russ and Marty, thank you both so much. Incredibly informative this morning, and lots of questions, lots of engagement, so we really do appreciate your time today. Look forward to seeing you both and to seeing Pacific Life at the annual meeting. For anyone who has yet to register, we do have a short window left where you can do so. We are about a little over 30 days out. Right now, we start up on April 30th. Here in Washington, D.C. So you can go over to AALU.org and go to the annual meeting tab on our website. You can see all of the information about the workshops, the main platform, as well as registration information. So again, thank you to both Marty and Russ for an incredibly informative presentation this morning, and we look forward to seeing everyone soon. Thanks so much. Bye-bye.